How to invest in Chinese stocks. If you are curious about how to invest in Chinese stocks, you are in the right spot. Investing in Chinese stocks can be a great way to tap into one of the fastest growing economies in the world. However, it is essential to understand the unique aspects of this market. Let's break down how you can get started. First, you can consider direct stock purchases through brokers. This means buying shares of Chinese companies listed on exchanges like the Shanghai Stock Exchange or the Shenzhen Stock Exchange. However, keep in mind that foreign investors often face regulatory restrictions. Many brokers offer access to Chinese stocks listed on international exchanges, such as American depositary receipts that representing shares of Chinese companies. Another option is to invest in exchange-traded funds or mutual funds. These funds pool money from many investors to buy a diversified portfolio of Chinese stocks. This approach reduces risk and makes it easier to access the market. Look for funds that track indexes like the MSCI China Index, which includes large and mid-cap Chinese companies. You might also want to explore investing in Hong Kong-listed Chinese stocks. Many large Chinese companies list their shares on the Hong Kong Stock Exchange. These shares, known as H-shares, are more accessible to international investors and allow you to invest in Chinese companies without dealing directly with mainland exchanges. If you prefer indirect exposure, consider investing in multinational companies that have significant operations in China. This strategy gives you a way to benefit from the growth of the Chinese economy without directly investing in Chinese stocks. Now let's talk about the practical steps to invest. First, open an account with a brokerage that offers access to Chinese stocks or China-focused funds. Next, decide how much you want to invest. Many brokers allow fractional share purchases, so you can start with smaller amounts. Research is key. Look into different sectors, company fundamentals, and your own risk tolerance when selecting investments. You might also want to consider making regular investments over time. This strategy, known as dollar cost averaging, helps spread out your purchase prices and can reduce risk. It is important to be aware of key considerations and risks. The regulatory environment in China can be complex, with restrictions on certain sectors and capital controls that may affect liquidity. Additionally, Chinese stocks can be more volatile due to various economic and political factors. Currency risk is another factor to consider, as investing in Chinese stocks means exposure to the Chinese yuan, which can fluctuate against your home currency. Transparency and governance standards in China may differ from those in Western markets, which can pose additional risks. Finally, be mindful of sector concentration. The Chinese market is heavily weighted toward technology and communication sectors, but there are also significant opportunities in banking, solar power, healthcare, and consumer goods. To sum it up, investing in Chinese stocks involves opening a brokerage account, choosing between direct stock purchases or funds, and understanding the unique risks involved. By following these steps, you can participate in the growth potential of Chinese equities while managing your investment strategy effectively.